Thank you, Svetlana, and welcome everybody. Indeed, I will be moderating today's session, and I'm very pleased to have Giammarco and Arthur with us. Let me maybe first introduce my guests a bit in more detail, and then we can get into the discussion. So first, let's start with Giammarco. Giammarco has many years of transfer pricing experience, having worked for the tax authorities, the OECD, more recently at Netflix, and currently head of tax at Agoda. And Arthur has started his career many years ago at the Dutch tax authorities, even though he looks very young and still very energetic, as you will notice during the presentation. He also has worked at Big Four, as well as served many multinationals and in-house type of roles. He currently has his own advisory firm advising his clients. Then, of course, we have you, our audience. Your contribution will also be very much appreciated. Please post your questions in the chat, and me and Svetlana, we will be addressing those questions to our speakers. What do we have on the agenda today? We plan to have a very engaging discussions about profit attribution to PEs. And this topic, the profit attribution to PEs, is perhaps one of the most thought-provoking as well as contentious one in transfer pricing. And I'm personally very curious to hear what our speakers will say about this. Generally speaking, permanent establishments are dealt by domestic law. However, we also have OECD, who has provided guidance in this respect in Article 5, in Article 7, and in the commentaries to those articles, as well as a detailed OECD report published in 2010. And then, of course, it is worth discussing whether Article 7 versus Article 9 and whether they should be applied in the same way or differently. Whether the control over risk concept in Article 7 is same as risk management concept in Article 9. All of that will be discussed here. Another important question that we will touch base on is whether this guidance is actually followed by the countries that have to deal with this. We have two types of countries: legalistic countries or countries that are following more of a legalistic approach versus countries that are following more of an economic approach. For instance, Italy. Giammarco will discuss it in more detail. It takes this PE recognition issue very seriously and can take it to the level of imposing criminal charges. Whereas in the Netherlands, we focus much more on the profit attribution, and not so much on the recognition aspect. And also, PE has broader concepts than just for CIT. We will touch base on employment issues as well as VAT, and finally, in the digital age, how to deal with global mobility and remote workers. Without further ado, let me first give the floor to Giammarco to set the scene with introducing us the conceptual framework that has been introduced by OECD, as well as introducing our UN perspective.
Thank you, Rezan, and thank you, Svetlana. It's a great pleasure to be today with you all, and it's a great pleasure for me to have the opportunity to share my thoughts together with Arthur. With this many years of practical experience, I think we will try to combine and provide you a proper cocktail blend by providing you with sharing some thoughts that can be somehow thought-provoking. But as Rezan just mentioned, we thought it could be helpful to try to set a little bit the scene before jumping into some practical real cases, because something that at least we have been experiencing until now is that one thing is the theoretical framework that is being very elaborated by both the OECD and other international organizations like the UN. And then you need to not to forget that then each and every country can decide to apply the guidance at the OECD level in the way that they most see fit, and sometimes in a way that is not always consistent with the standard that should be shared internationally. So first of all, why we decided to choose this topic? Well, clearly at the moment, if somebody think in the world of international taxation, which is the concept that is most under pressure and which has always been under pressure, is the one of permanent establishment, simply because in very plain terms, it represents that nexus, that requirement that the host state needs to be somehow able to identify for exercising the taxation of business profit. And generally, when we discuss about permanent establishment, and if we look at the case law of the last, I would say, 15 years, the focus on this topic is just on answering the first question, that is whether or not a permanent establishment is deemed to exist. And as Rezan just mentioned in his presentation, obviously determining whether or not a PE exists sometimes can have consequences that go beyond taxation, including the possibility of moving criminal charges versus some of the representative of the company, which is allegedly, exposed to the presence of a permanent establishment. But today, we are going to try to answer with Arthur to the second, in our opinion, most controversial question, the mostly important question, at least in my view, that is, assuming that we do have a permanent establishment, how are we going to attribute profits or losses to the PE itself? I would say that if we look at the very first introduction of the concept of PE, that goes back to the 1920s, and if we move 100 years back, there has always been an emphasis over the notion of physical presence. Physical presence is something that also, according to the authorized OECD approach, has been clearly of prominence in determining then profit attribution. So what do I mean by that is that often when we will see discussing the authorized OECD approach, sometimes a presence, some sort of physical presence that then is translated into function, then is needed to attribute profits to the PE. But now, of course, we are living in a more and more increasingly digital world, where clearly there is no need for a multinational enterprise to be present physically in order to have a sustained economic presence in the activity of a foreign jurisdiction. So how do I do that? Not just for purposes of determining whether a PE exists, but also, most importantly, to determine how much profits I should attribute to that. This is something that, if we look at the concept of permanent establishment, it's very broad, in the sense that it is a concept that does not go only in determining whether or not the business profit might be taxed by the host state. So by the source, when I mean the host state, I'm mostly making reference to the source state rather than the resident state. But it is also a concept that is relevant to the tax jurisdiction, where this permanent establishment is supposed to be present when it comes to the possibility of taxing passive income, so interest or royalties, for instance, to the extent that the tax administration will be able to prove that this income is effectively connected to a permanent establishment, but also for other, and I would say increasingly relevant concept or principle of international tax, such as the possibility of taxing employment income. So in the world where there is this very much abused word of digital nomads, the concept of employment income steps up, and therefore I can also have the possibility to tax employment income to the extent that this income is borne by a permanent establishment. Well, this is in general terms, but then if we start then to basically get more focused on the notion of attribution of profits to permanent establishment, I would say that this has been not a discussion, but rather a saga that took place in 13 years, from 1998, actually I would say December 1997, when the OECD for the first time developed a working hypothesis to basically try to further enhance the severed entity approach when applied to the attribution of profits to a PE, until 2010, when the OECD elaborated the report on attribution of profits to permanent establishment. And I would say that this has been an interesting exercise because, while nowadays we try to discuss the concept of the arm's length principle and its shortcomings within the ambit and the framework of Article 9 of separate enterprises, the definition of attribution of profits to permanent establishment and the very first elaboration of the concept of the arm's length principle can be found in paragraph 2 of Article 7 of the OECD Model Tax Convention. I don't see anymore the presentation on the screen. Now, thank you, Svetlana.
That's my fault.
to get it back. I would say that there are maybe, I'm sure that when we with Arthur we went down into reflecting a little bit on this notion. We found that now fast forward into 2023, some, I would say, scenarios where the authorized OECD approach is a little bit stretched in its interpretation. The first one, it comes to the fact that Clearly, especially after the implementation, the ongoing implementation of Action 8, 9, and 10, there is an increased tendency, at least from a practical standpoint, by tax authorities and sometimes even from taxpayers, to try to blend the approach from an Article 7 standpoint and an Article 9 standpoint. Clearly, if you look specifically at the notion of accurate delineation of the transaction, the fact that we are trying to identify the relevant economic characteristics of a transaction, and if we look at the new updated wording of the transfer pricing guidelines, you will see that there is an increasing resemblance with some of the concept and the terminology that was already introduced in 2008 with the first iteration of attribution of profits to PE. So I would say that a first important concept is to what extent are we able to draw a line in distinguishing within a pure Article 7 scenario when it comes to attribution of profits to a PE, starting, for instance, from the very important argument that in the attribution of profits to PE, contracts do not play a role because they simply do not exist in the internal dealings with between an head office and a PE, as opposed to an approach that sometimes tend to also use concepts such as economic ownership also in a context between Article 9 that, in my opinion, should not find too much space because the notion of economic ownership within the authorized UCD approach tend to serve a different element. I would say that is often misconstrued the fact that the OECD itself talk about the AOA, authorized UCD approach. And if we focus on the adjective authorize, it seems to infer that every country around the world, when it comes to attribution of profits to permanent establishment, should adopt the two-step approach that we are going to see shortly. Well, the reality is completely different. And the reality is completely different in that if you look at different bodies, such as the United Nations Tax Committee, the OECD approach on attribution of profits to PE has been rejected. A number of relevant countries that are part of the OECD, I'm thinking about countries like Australia or New Zealand, for instance, they're also been very clear in rejecting the authorized OECD approach that, in a nutshell, provides that I can have a situation where, from a tax standpoint, a permanent establishment can report a taxable profit or a taxable loss, irrespective of what are the tax result of the enterprise considered in its entirety. So in practical terms, then, when we look at, especially at some of the most important cases around attribution of profits to permanent establishment in the last 15 years, starting from the Zimmer case, that was the French case that led to basically the discussion around Action 7, to other relevant case law in Spain or in Italy, now up to the Netherlands, most of the time, judges fall short in their decision in determining how to attribute profits to a permanent establishment. That means that oftentimes the conversation around the attribution of profits to permanent establishment tend to answer only the first of the two questions. So the question that tend to be answered is, do I have a PE or not? But from a taxpayer perspective, what is really clear is that there is a consistent application of the OECD approach when it comes to attribution of profits. So if we move to the next slide, in a nutshell, what does that mean? Authorized OECD approach. An outline, if we try, conscious of time, to summarize in two steps what the OECD suggests in attributing profits to a permanent establishment, you see that it's clear that step one requires, and that's why there is a clear resemblance to where we are nowadays with the actual delineation of the transaction, the need to perform a functional and factual analysis to determine the activities and the condition of the permanent establishment. This does not mean that a taxpayer should, in a flat way, consider that all the transfer pricing concept that you can find in Chapter 1 of the guidelines should apply also in the AOA. Because, for instance, the exercise on performing a functional and factual analysis then require the identification of the significant people functions. That is something that it's a proxy that the OECD has been developing to then guarantee the economic ownership of the asset to a permanent establishment, absent the role of contracts that instead are present when you are performing a transfer pricing study in between two associated enterprises when you apply the transfer pricing guidelines in the context of Article 9. I think also the second step, determining the profits of a permanent establishment, the OECD very carefully chose the use applying by analogy the transfer pricing methodology to attribute profits. So again, when we are looking at the concept of significant people function that require active decision-making in the assumption and management of risk, the concept of significant people function is different, at least in my opinion, from the notion of risk management or financial capacity to assume risk that is then warranted by at least the first and the second step of the AOA. So in a nutshell, basically the OECD, as at least in its first iteration of the AOA, try to stress the relevance of some concept, also to stress the difference between an Article 7 approach versus an Article 9 approach. And we are going to see that when we are going to present some cases now with Arthur. But I think that it's also concrete, the world that we are living right now in 2023, where more and more there is, I would say, a narrowing distance between a PE approach under an Article 7 and a TP analysis under Article 9. The reason being that in the accurate delineation of the transaction, tax administration around the world tend to stress more and more the relevance of the actual and factual analysis of what is going on in the country where the permanent establishment is supposed to exist. So again, today, for purpose of this presentation, we are not discussing whether or not a PE exists. We are focusing on the second question, but clearly you should approach them together and not in isolation. Having said that, I'll stop here and I'll pass the
just
word
maybe. Thank you, Giammarco. I think that was an excellent introduction. I think a couple of things maybe to reflect on. I will ask first to Arthur to reflect, let's say, what his take is on the OECD approach. But because you discussed a couple of very important matters, I want to first, let's say, reflect on that and see whether we can clarify some of that a bit further. I remember when I was doing my master's degree in taxation in 2011, one of the fellow students asked the professor, we have this significant people function concept, and why don't we have that for, let's say, Article 9 purposes? And the professor reacted, as a professor that we both know in common, Kees van Raad, well, that's a very good question, and that should be actually the case going forward. And then later on, a couple of years later, we start seeing more the concept of important people functions. And then, of course, control of risk shifted towards more risk management. I understand that there is a difference between PE versus, of course, the legal entities, in the sense that PE cannot have a contract. But if you look at the OECD guidance, it also says that contracts can only be used as a starting point. So if you go through delineation, aren't you, in a way, for profit attribution purposes, resulting in the same outcome? And I'm saying this also because I know many practitioners pretty much apply them in the same way. Giammarco?
I think Arthur was first. I think he's muted though, and then I will respond.
Okay.
Unless you want me that I go first.
No, whoever. But I would like to hear your view on this one. And Arthur, perhaps you can start with reflecting on the OECD approach, because I know you're a bit skeptical to that.
Thank you, Rezan. Yeah, I'm always a bit skeptical about the OECD. And again, I think, the approach, the AOA approach works, as Giammarco, brilliantly explained. It works well in many, many countries, but not in all countries, right? And I think what you do see is that, from my perspective, it is fantastic that the OECD provides us guidance when it comes to allocation. A matter of fact is that, the practice in countries, it's, at the end of the day, it's always local legislation which defines, what is the ultimate outcome when you have discussions and debates with local tax authorities. And, also, Rezan, you also raised an interesting point about those agreements. I have seen, consultants that say, well, put in all sorts of intercompany agreements between, you know, the main establishment and the PE. Where as a lawyer, you know, I get goosebumps because I say, well, you know, you can't contract with yourself. So legally, it's nil and void. There's no point whatsoever in doing that. But again, it's often you do see intercompany agreements with permanent establishment, and I think the only reason that they're doing that is trying just to, you know, to beef up the case, to say, well, you know, certain risks, certain functions are indeed allocated to the PE. So I think you have to be careful with the you know, the approach. I think, yeah, you do see a change, and you do see more and more countries using it. I think in my example, you also see that the AOA is indeed, you know, applied, and it works. I mean, I'm not saying, when I say it works, it's not always, I think, you know, to the advantage of the taxpayer. They're not always happy when they see when you apply it.
Look, I think when it comes to significant people functions, this is, in my opinion, is the most misunderstood concept out there in international tax, or one of the most misunderstood concepts. Maybe because possibly the OECD have not, it should have reiterated what it meant when it was first developed. I believe that the concept of significant people function is there for a purpose, and is the one of indeed trying to justify why I can hypothesize the permanent establishment as an independent enterprise, absent the attribution of risk by means of a contractual arrangement. I know that nowadays, in practical terms, more and more tax authorities tend to dismiss, and I understand also where they're coming from, why a contract should not be as relevant as an accurate delineation of the transaction. But again, I think Arthur made a very valid point. At the end of the day, here we are talking about soft law that then each country has to decide how to interpret in its own domestic jurisdiction. So thinking of a country like the United States, for instance, in the United States, contracts play still a prominent role. And the concept of significant people function has been developed for the very purpose to explain how to allocate risk, and then how to apply transfer pricing method by analogy, applying the transfer pricing guidelines in a situation where I do not have contracts. So in the example that I will provide in the investors versus fund management, so in the private equity industry, it's one of the examples that the OECD already developed back in 2009 in the business restructuring chapter. I think that this could be a clear scenario where you could see where, depending if you are in an Article 7 or in an Article 9 context, the outcome from a TP standpoint could be completely different. So I think that there is it's the significant people function as, I think, like any criteria or any benchmark that is based on factual elements, as a degree of subjectivity. And whenever you have a degree of subjectivity on how you interpret facts, then the outcome might be different, and therefore controversies may arise. And that's, unfortunately, is an uncomfortable truth that we need to accept. It's not something formulaic, but whenever there is room for interpretation, there is room for subjectivity, and then there is possible room for conflict.
Yeah. All right. Thank you both. Svetlana, do we have any questions from the audience? Otherwise, we can move on to the case studies.
Not yet, but I would emphasize again that if you have any questions, please put them in Q&A, and then we will be able to ask them.
Right. Let's move on to the first case study then.
Yeah, so this case study, as I mentioned to you, is applies to the investment fund industry, so private equity industry, and is a scenario where generally most controversies in determining whether or not a permanent establishment exists and how you attribute profits arise. So there are some key fundamental issues here. So the first one is assuming that we have I don't know, an alternative investment fund manager resident in Luxembourg with setting up a subsidiary company in the Netherlands that provides advisory activities on certain type of investment. This is already something that then can raise some question, specifically from a Dutch standpoint in this case, because I would ask what type of functions the advisory entity in the Netherlands is performing. So assuming that there would be a permanent establishment based on the significant people functions of the advisory entity in the Netherlands, how would I attribute this? So in this case, I already see a first dilemma. Assuming that the advisory company in the Netherlands is a subsidiary, why do I need to attack this structure with an Article 7 approach? But this is because, in my opinion, if you do your homework right, you should try to basically solve the issue within an Article 9 framework without, I would say, exceeding in the domain of Article 7, challenging that the activity of the advisory create a PE, in this case, in the Netherlands. But in practice, sometimes you might receive in other jurisdictions this type of challenge. Then you have also the second side, and I would say the broader part of the picture, that is also the fact that the alternative investment fund manager abroad is also performing management activities for the foreign fund that subsequently set up an SPV that is then utilized for, let's say in this case, the acquisition of an Italian target. Also here, I might have a question whether or not the activity of the foreign fund might create a permanent establishment. And if that is the case, again, for the sake of this exercise, we are also assuming that the foreign fund could create a PE, although I don't think that this should always be the case, but rather the contrary. But then the key question here, when it comes to attribution of profits to PE, is how do I implement the two-step approach in practice? And in implementing the two-step approach in practice, I would have to focus, according to the definition of significant people function, to those activities that require active decision-making. So I would like to stress that when it comes to the distinction between Article 7 and Article 9, active decision-making, at least in my personal opinion, is something that falls mostly into the day-to-day activity in deciding how to manage or a certain investment or how to perform a certain investment. But the day-to-day activities that seems to be inferred by the definition of significant people function is something different than the definition of risk management or control over risk that is instead very much stressed in section D2 of chapter 1 of the transfer pricing guidelines when it comes to the accurate delineation of the transaction. Because as you know, the concept of control over risk departs from the notion of day-to-day management, but requires an oversight in taking some more fundamental decisions. So in this concrete example, assuming that the alternative investment fund manager is performing an oversight over the activities of the advisory entity in the Netherlands, what happened there in terms of assuming that these activities are strategic or not? Because if the activity of the advisory are basically limited to the day-to-day, possibly I could have an argument to say, well, possibly there are some significant people functions that should need to be attributed to the advisory in the Netherlands that could warrant a greater attribution of profits. But if instead I look at this structure with the eyes of Article 9, I should not apply the concept of significant people function, because again, significant people function, in my opinion, is a concept that should not have room when you are dealing with two separate associated enterprises. But you should instead apply the notion of control over risk or risk management. And in my opinion, in this example, if the risk management is not performed by the advisor in the Netherlands, but rather by the IFM or by the foreign fund, then obviously the selection in terms of attribution of profit would significantly be tweaked and changed compared to an Article 7 scenario. So I think the investment fund industry, that is also something that very interestingly, the OECD, as I mentioned to you earlier on, used as the first example when in the first presentation of Chapter 9 on business restructuring was adopted, when it was when he was using the example of the fund manager and the investor. It's a very helpful but often misconstrued situation by tax authorities where there is a conflation in which the notion of significant people function enters into the world of separate enterprises. Because I still find, from a practical standpoint, difficult to understand why, in a situation where I have two separate legal entities, I need still to attack the structure with a dependent agency of a permanent establishment. Also because most of the time, tax authorities tend to depart from the two-step approach when it comes to dependent agency or permanent establishment, but they tend to take a more, let's say, aggressive approach by attributing as much revenue as possible and translate as many revenues as possible at the level of the permanent establishment into profits and denying cost deductibility. This is, I would say, in a nutshell, something that I have experienced over the years. And I still hear from colleagues operating in the industry that is the case.
Yeah. So, Giammarco, what you're saying, we have a question as well. I think that what I'm going to ask overlaps with that as well. That in the context of Article 9, let's say the guidance allows you to basically outsource day-to-day activities, while you can have oversight from another entity that you would like to allocate more profitability to it. Whereas in the case of PEs, the day-to-day is resulting in whether you have a PE or not. Can we summarize like that?
Yes.
Yeah.
So and maybe this is a good segue also to the question of Federico that I see has put in the chat that I say hi to. In my opinion, the concept of significant people function is fundamentally different in the way that at least it has been conceived from the concept of control over risk in the context of Article 9. Why? Because in my opinion, at least the way I read it, the concept of significant people function is crucial in hypothesizing the PE as a separate and distinct enterprise from the rest of enterprise in which it operates. But if you look at the wording of significant people function, it refers to the activities that require active decision-making in the assumption of risk and in the attribution of the economic ownership of the asset. Active decision-making, in my opinion, seems to be resembling more an activity involved requiring a day-to-day involvement, as opposed to, as you said right now correctly, Rezan, the definition of control over risk or risk management that instead says that, stipulates that even if I outsource the day-to-day activities, but I'm performing some oversight in terms of taking key decisions, including putting the capital at risk or assessing whether to hire or terminate or fire a third party, in that case, I would say that I'm exercising risk management. But the two concepts tend to respond to two different elements. Significant people function is fundamental to hypothesize the PE as a separate and distinct enterprise. Control over risk is crucial for risk allocation. That is something that in the PE authorized UCD approach come after the application of significant people function, but rather in step 2.
Very good, very good. So I think we have more questions coming in, but before, let's say, addressing those to you, maybe building on this example. So I come across, let's say, on a regular basis, companies, especially asset-heavy and functions-light companies, like real estate companies, for instance, that put few people in a certain country who are managing. Most of the time, they are propcos, property companies that own the assets, and then the management of that company is in another country, and they fly in every now and then to basically take strategic decisions through board meetings, or 4 times a year generally. And then those companies have also directors who may be or may not be resident in the countries where day-to-day activities take place. So would you, and this question is to both of you, I would like to take the view of both of you to this question. Would you think that this structure is kind of safe to continue with from a PE perspective?
Well, safe is a difficult word in tax always, right? I think the issue always is that, and you know, what type of, I think that's relevant. What type of PE would you have? And that also indirectly determines the profit allocation. Because to me, and that's also like, so I agree with Giammarco, if you look at the case, you know, here, if we have two legal entities, it's basically an Article 9 issue, right? So it's the allocation of, you know, what's the taxable base, is that sufficient or not? If not, tax authorities go to Article 7. Now, in your case, Rezan, I mean, it's the same. I think, first of all, you really need to have that discussion with the tax authority if they deem a PE, first of all. You know, is it really a PE? Are we talking about a fixed place of business? Are we talking about an agency PE? If we, for example, would talk about an agency PE, that also determines, I think, let's say, the range or the scope of the profit allocation, because that has that has an impact. And then we indeed go to, okay, there are certain functions performed here, and what are those functions, and what is the profit that we can allocate to? Does it make sense?
Yeah, certainly. Giammarco, anything to add to that?
Sorry, I was muted. I was reflecting on some of also the questions that are coming in. I think in your case, Rezan, if I have, let's say, the real estate company and I have the directors flying in and out, obviously, I think, so it's clear that from a tax authority perspective, at least I speak, I don't have, obviously, this is such a gray area that whatever I can say can be confuted, and I would be happy to be rejected in my views. But whenever I see the concept of significant people functions applied, if I am in a pure Article 7 scenario, this generally occurs when I tend to attribute, I try to attribute more profits to what I've been determining, let's say, towards a subsidiary through a transfer pricing methodology. Is it needed? Possibly some countries, and I speak from a practical experience. I think there are people here in the audience as well that are way more prepared than me on an academic knowledge on this one. But generally, if I'm trying to argue that a PE exists, even in the presence of a subsidiary, is mostly because I also want to put pressure on the taxpayer by, let's say, moving criminal charges because I didn't declare a permanent establishment in order to try to increase the remuneration. And the question then is it needed? Because if, again, I look at the way in which the transfer pricing guidelines have been drafted, there is a degree of subjectivity, but I don't think that the OECD could have get any better than that with a 6-step approach. Because if you do your exercise right, if you properly perform the accurate delineation of the transaction, then you can get an outcome that most of the time as a tax administration you're trying to achieve by using a concept, the one of permanent establishment, that is the most subjective that you can find out there. What does it mean? Again, active decision-making as opposed to risk oversight. I see one of the questions that have been posed by Cristo here. I think, and I also see Richard putting two questions that I'll try to address. So in the case of Cristo, he asked, in case a significant people function would imply day-to-day management, and to me the answer is yes, which I tend to interpret as non-strategic, and that is very subjective, because let's say if I'm in the financial service industry and on a day-to-day basis I need to decide on what securities to invest, this might be also strategic. Does this mean that the PE could not be attributed profit arising from an IP based on key decision-making on DMP functions performed by the PE? So I don't understand now. I think here we are confusing a little bit why now we are bringing in another important concept, the one of DMP and the use of IP, because remember that sometimes we as tax people tend to complicate things that from an economic standpoint are very straightforward. The first, I think, reality is every function needs to be remunerated. Then we can put on a scale the relevance of a function. But if I'm a permanent establishment, I'm performing a function, and this is what the AOA says, every function needs to be remunerated. Then within this realm of function, you have those functions that are significant. And what the OECD interpret as significant are the functions that require active decision making. So this is, and then this is where the degree of subjectivity comes. Then to reach our questions, but then I'm also happy to hear what Arthur has to say. Was his active decision making in what time period, the current assessing year, or taking account of historical decisions that continue to be material? That's a great question. I think that this can vary looking at the years under audit. Generally, I think my personal bias reaction would be you should look at the year under audit and how the people involved in the PE arrived to such a decision. But it could be broader than only the current year of assessing. But again, this is just my personal opinion. And your second question is, why does the ability for various other reasons to subdivide an enterprise into legal pieces matter for the objective of TP to measure income in relation to where endeavors to earn it take place? Yes, I think that's, I mean, that's the fundamental reality of saying, do we really need, in the world of transfer pricing, if I understand your question correctly, the need to separate the enterprises into legal pieces? If I read the arm's length principle as it has been structured, the answer is yes, legally. Does it make sense economically? Not really, not really. So, and you say related, are people function just a metaphor for directing attention to the location of a relevant presence? It is always being necessary to measure their value. The answer is nowadays, no. I can tell you that again, with the company I work right now, but the company also was working before. I can certainly be present in the life of a country without being physically present. This is something that, in my opinion, from a conceptual standpoint, the OECD very rightly tried to address with Pillar 1 and Amount A. But then the question is, and this is something that I don't have an answer to, and apparently many countries are still debating, is assuming that I don't need a physical presence, then do I need to stick to this separate entity approach and the arm's length principle to attribute profits to it? Those are two fantastic questions, Richard, and I think that for those of you who are in the audience, I come to my mind, some of you, you should try to write an article to try to answer Richard questions, because those are really go at the heart of this debate. So thank you both for asking that.
Thank you, Gianmarco. Excellent discussion. We have about 15 minutes to go. And we have one more question, but let's move on to the next case study, if you don't mind. And Arthur can, I think he has prepared a very good, or are we going to cover this slide as well very quickly? Or shall we move on to the case study? I leave it up to you.
We should move to the case study for Arthur,
yeah.
I think. Yeah.
Okay. Arthur, please take us through your case study.
Well, the case study is, as you can see here, it's a healthcare case, and it's a situation and let's call it a vehicle that I see often, the sales and marketing support branch, which in many cases is a permanent establishment. And in this case, we had a Swiss single billing entity selling medical devices, in this case, to patients. A branch office in Denmark, and what absence of the branch office, or 2 sales support staff and 1 executive team member, and we had just now fantastic discussions about significant people functions. Well, this is such a a case in practice, and in general, what you see often is that leadership of a company are scattered all over. Right. So in the old days, everyone, moved house and everyone to the HQ of a company if you were so fortunate to get a job there. But now everyone stays, partners, they're all working, they have kids, they don't want to move. So we do have this issue in many, many companies. Senior leadership is scattered all over. So this is a serious issue. So Svetlana, can you move to the next one? So here, just again, very quickly, this is basically the authorized OECD approach. What you're doing here is you're hypothesizing that the PE is a separate entity. So you start with your functional analyses. I usually go, try to use an org chart. That is always very helpful, or even job descriptions. Again, that's usually an Achilles heel of companies in HR, where they once make a job description and never update it. So, but usually an org chart is that's a good start. Second, of course, you're going to attribute assets, risk, capital, and then dealings, intercompany agreements, which, well, we just briefly discussed the fact that might be, an issue, that there are no legal agreements there. And then second step, you determine the PE profits. So here you see, just to go a bit, again, I don't want to ponder too long on the example, but here you see that we have this branch. It's a sales and marketing support branch, but we have that one executive team member, the lady here, who's also a sales director for the whole Scandinavian area. So we kind of allocated 1,000, that's the revenue of the Danish branch, including 800 really for Denmark and 200 other Scandinavian sales. The cost of goods sold, that's always what I call the plug. That's the transfer price, the fictional transfer price from the single billing entity, which we have to treat the PE as a separate entity. We benchmark the revenue on sales, which is a 2%. And if you look at the OPEX, that's also a given, the 200, where 120 is the fully loaded remuneration package of this senior lady, and the 80 is the other branch cost, which is like the other staff and possibly the rent of the office. In this case, obviously, you have to look at really, when we talk about significant people functions, well, this lady who was in the branch she is performing significant people functions, right? She's the sales director for Scandinavia, and she's an executive team member. We determined a split of her activities, 20% branch related and 80% HQ related. So if you go to the next slide, you can see that basically you're basically changing or separating the two different activities in the branch. Obviously, I mean, the client basically said, when we're setting this up, say, well, I really prefer looking at the function of the branch, which is the sales and marketing support. So they were expecting just a simple cost plus, but the Danish authority clearly said, well, if we apply the AOA, it's much more than that. And there are really significant things happening here. And certainly the sales, which is a core activity of the branch. So basically, you're looking at trying to allocate a reasonable profit to the distribution function of the branch. And that obviously was an issue with the client, because they were expecting a lower profitability. But you have to also look at the services, because they basically said, well, the Swiss single billing entity, they should basically, be recharged for at least 80% of the cost of that senior lady. So this is what the end result was after negotiation. And basically just a very simple, straightforward example of how you determine and allocate the profit of a branch. And then if you go to the last slide, well, you see in practice that the issue always is in transfer pricing, we have to be consistent. And we started the discussion with, well, the OECD approach, where hopefully you would have a uniform approach. Well, in practice, that's an issue, because countries do have their own take on the allocation of profit. And for example, I mean, certainly, at least that's my experience, HMRC, when you talk to HMRC, they really prefer Article 9. It's always kind of, you know, what's the transfer price? What is the allocation? And that's basically, you know, we're going to agree on that. I had a discussion with SARS, the South African Revenue, about a PE, also of a Swiss company in South Africa, where the rules in South Africa basically said, well, you have a PE, and we can't deny that. But then when we looked at the allocation issue, it was really with SARS. Well, if I look what's happening here in South Africa, you know, we're basically happy what the sub, because it was a subsidiary company of the Swiss entity, what they're reporting here. So we do have to issue a tax return every year, but it's a nil return. So that can also be the conclusion. So you have a lot of differences per country. The issue, I think, with PE is the difficulties when you talk about clients with, you know, about PE, they're always apprehensive about PE. And I wrote my PhD more than 25 years ago on the agency PE, and the tax world then was completely different. When you look at, you know, PE about allocation of profit, so a lot of things changed dramatically over the last years, and you see that companies again are very apprehensive about that, and certainly when it comes to allocation issues, that when there is a PE, of course, you know, they want to be kind of aggressive and have the tax base as low as possible, and there, you know, it's a very difficult one. And obviously, like an APA option, you know, many countries you can have a ruling about this. You know, in the Netherlands, you can have a ruling about the profit allocation of a branch. In many countries, the question there is that, but that's a more separate topic. You know, is that a desirable outcome? In some cases, certainly that can be the right answer. I'm always very apprehensive about, you know, going for an APA in a ruling, because you always have to pay a price for, you know, obtaining that certainty. And certainly when, you know, I've concluded rulings on the profit allocation of a PE, and at the end of the day, where the competent authority is willing to agree on is always a higher net operating margin than you hoped for. So you're paying a price for that. So I think, Rezan, that's more or less, I'm looking at the time, 5 minutes. I'm pretty sure you...
Yeah, I had maybe a follow-up question, and we have a couple of more questions coming through the chat. I don't know if we will have enough time to cover them, but let's start with one that I have in mind. We I think all agree that different countries approach this issue differently. Then the question is, based on your experience, Giammarco and Arthur, what would be your recommendation to the taxpayers who are dealing with this when countries go with their local rules instead of, you know, following the OECD and its guidance when it comes to profit attribution? How do you...
to be very practical.
Yeah.
Well, if I'm very practical, I always advise, when it's in your favor, call in the OECD. It's very simple, but be very opportunistic. I mean, if it helps you, and again, I think that also boils down to the consistency, of course. I think, you know, any structure when it comes to P and allocation of profit, if you have a consistent approach in your transfer pricing policy, I think that's always a good argument. So I'm very pragmatic. In some cases, it will not help you, and then you're trying to come up with other arguments. But if it helps you, you know, certainly, I mean, I call in the OECD often, of course. I mean, it might help you in some cases.
And Giammarco, before you go, maybe can you also touch base on the role of courts in tackling this issue? How do you see that?
Well, I think the role of courts at the moment is, when it comes to attribution of profits to permanent establishment, almost non-existent. in the sense that, as I mentioned to you at the very beginning, unfortunately, courts in the overwhelming majority of cases, they just focus on Article 5 issues, and they purposefully, in my opinion, stay away and kept shy on taking any clear stance on whether or not the attribution of profits to PE applies. I think you share with us a very interesting decision that last year the Netherlands have took. I think it's the exception that confirms the rule, that hardly sometimes you still see the decision taken around this attribution of profits in litigating. But also I think because companies are very, I would say, cautious of taking the road of controversy in an area that again is very gray by default. So answering also to your earlier question, if I were a taxpayer, generally I would do two things. Number one, I would certainly try to shield my structure, not even with a bilateral APA, because a bilateral APA unfortunately encounters some limitation needed by the fact that the time to close an APA sometimes it's so long that after 6 to 12 months the business model of a company changes, and therefore it makes no longer sense to go forward with the APA. Number two, for those for those industries that sometimes require, for a number of reasons, to set up a branch office rather than a company, in that case I would disclose and declare immediately the existence of a permanent establishment, especially towards those countries that are notoriously aggressive and they attach criminal penalties in the event a permanent establishment arises. I'm thinking about my country of origin, that is a prime example for the good or the bad in this approach, but it's not the only one. There is also, I think, another often overlooked aspect of the discussion around attribution of profits to PE that is not direct tax issues, but is the concept of fixed establishment for VAT purposes. That is something that has been developed in the recent years by the EU VAT directive and by the case law of the European Court of Justice, that presents some overlap, but also some differences with the concept of PE, and also in that case, depending what we want to focus on, the outcome in terms of attribution of profits could be different, right? Because sometimes when you are in the concept of fixed establishment for VAT purposes, you are assuming that there are some services that are rendered. So how does that impact your analysis from a direct tax standpoint? I think in practical terms, there is also, I think, another, based on my experience, when you end up in a conversation where it's very debatable the existence of a permanent establishment, and then you decide to eliminate double taxation, and as a taxpayer to protect yourself by opening a map, oftentimes competent authorities tend to disagree on whether or not a PE exists or not. So I think I sometimes laugh at the fact that I hear over and over again this concept of tax certainty. People talk about tax certainty, but they don't even know what they mean by tax certainty. So tax certainty means especially eliminating conflict. Unfortunately, we live, and this is very bad, and I don't want to make any reference outside of the world of tax, but we live in a world of conflict right now. And I think we will need, in all fronts, we will need a little bit more peace. And peace is also try to avoid discussion around a notion that sometimes the solution is much easier. And as Arthur mentioned, we should be a little bit more pragmatic rather than being too orthodox in applying concepts that sometimes, as much as they are beautiful from a theoretical standpoint, sometimes they find some limitation in practice.
Can I
yeah, sure, go ahead.
One kind of comment on going to court, just to, I know that, a lot of taxpayers are very apprehensive going to court, which I understand. You have that reputational risk element. You don't want it to be in the newspapers. But as Giammarco rightfully said, I mean, there are hardly any court rulings on profit allocation. For example, I mean, if you look in India, where we go to court for everything, every assessment you go to court. So you see an abundance in court rulings. I always love India for that. I mean, the level of expertise is very high. So in many cases, I think also in Europe, if your case is strong, you know, don't be too scared to go to court. Again, it's always the decision of the taxpayer, but I think it's unfortunate because the more court rulings you have, the more clarity we're creating for practitioners. And for
excellent.
companies.
Thank you very much. Well, one of the last comments I would say is another question from one of our audience, former colleague of mine, Michael Mizio, actually summarizes how complex this topic is, because it doesn't sound like we're going to clear our differences with respect to this topic in 1 hour. As he says, active decision-making does not per se means important decision-making. So that perhaps shows how complex this is to deal with also in practice. I would like to thank you both. Svetlana, I'm handing over to you.
Can I also think, I mean, in a way where we have a criticism, just so I would like to thank all the attendants, and I also would like to extend my compliments. There is a guy in the audience, Mauro Fagion, that has been doing a great work at the European Commission level with a great piece of work with the draft directive on transfer pricing. I think these are the type of exercises that help. So I think, you know, we are very critical sometimes on, you know, the work, specifically on the PE issues, but I think, you know, this kind of efforts they really need to be also underlined. So bravo to Mauro, and you know, thank you everyone for listening, and thank you again for the invitation, and also of course to Artur.
Svetlana.
Thank you so much to the speakers and to the audience, and thank you for contributing to this webinar series. That was the second webinar, and which the next one will be on the topic which I think also is very dear to you, and especially to Giammarco, because he wrote his PhD on this topic, is the correlation between Article 7 and Article 9, and the differences partially we already addressed it today, but also we'll be addressing that again in December. So just stay tuned, and thank you again to our excellent.
Thank you. Bye-bye.
Thank you very much,
everybody.
everyone. Thank you.
Thank you.
Bye-bye.
Thank you. Bye-bye. Bye.